Okay. Okay, very good. I found the record button. So we're all now being recorded. Okay, let's start. Okay, thank you for all joining this morning on this. The idea of this hour or so is just to give a kind of broader context on some of the key considerations that are worth incorporating into your strategy when you're looking to raise finance. A little bit about me. First of all, who am I? My professional background is today I'm a private equity investor with Jolt Capital. We are a growth capital investor based in Paris. We have around 500 million of assets under management. We invest in technology companies, slightly later stage companies for us in our target zone are around 10 to 50 million of revenue. So not very early stage, not very late stage, but somewhere in the middle. We call it a growth capital. So it's not pure LBO, leverage buyout. It's not kind of early VC. And that's what I do on a day-to-day basis. I'm also on the board of a few companies, one in Germany, doing financial analytics in compliance and trading, and previous done some consulting. My longest background, I was a professional sports person for 10 years, and I worked in renewable energy for a period of time. On the academic side, I started in Dublin doing a degree in statistics, a business diploma. After that, I did my first master's in Brunel in London in climate change impacts and sustainability, and then I did my MBA at HTC Paris, where I did a few other certificates in advanced management and mergers and acquisitions. Okay, first off, on fundraising, so some introspection to understand, kind of ask ourselves those difficult questions. What type of business are you actually trying to build? Is it scalable? Is it a lifestyle business, or is it just a pipe dream? Is it scalable is important because investors won't really look at it unless it's scalable. If it's a lifestyle business which has an early plateau in its probable revenue, therefore the upside's not high enough and it's not worth the risk. The risk return won't make sense. So the business needs to be a particular type of business for it really to be investable. And when I say investable here, I refer to professional investors. You can always raise money from friends and family, and they might finance things close to your heart. But for professional investors, they will typically require a scalable business, meaning a very, very high upside, which potentially has the opportunity to mitigate any risk, and the risk is quite high. If it's a lifestyle business, it's less financeable. Professional investors won't really look at it. By a dream, I mean it must be a business. It must be actually something which has a high probability to generate revenue, of course, but profits in the future. It's not a business which is just based on raising money and spending it. That's not a business. That's closer to what the definition of a charity. What do you want, or what do you need? Do you really need it or just want it? It's a key question. When you're raising money, there are other parties are taking risks. So do you actually need it, or you want it? Do you want to raise lots of money because it's good for your aspiration, your ambition, perhaps ego, or do you actually really require it? Do you have a way to spend that money? Another question, is it only money you require? Do you require support, advice, counseling, mentoring? And can you get those things for free? Do you have to raise money which dilutes you within your own company? Can you get it for free? There are creative, resourceful ways to actually get a hold of assets, technologies, licensing, intellectual property for very close to zero, which doesn't require large amounts of money. Why do you want to need that? What is the market? Can you really serve it with certainty? Are you credible? The market should probably exist to increase your chances of raising capital. Can you serve it? Do you know how the market is functioning? And are you credible? Will people look at you as a custodian of their wealth, which they are putting into you to actually manage it? If you can't answer those questions quite strongly, quite immediately, it might be worth revisiting your strategy, your plan of actually what you're doing. What justifies your fundraising ask? By that I mean the quantity of money you're looking to fundraise. Why that amount? Why not more? Why not less? But why that amount? If you're asking people for several millions of euros or dollars or pounds, that's a big ask. You should be able to tell them with a high degree of clarity why that is, where the money will be spent, and what they get in return, and why they should trust you. If your pitch in that regard isn't strong, you need to work on it, because you will probably go through lots of failures. What's in it for the other side? How do you create value for someone? When you're raising capital, you're not going to a money tree asking for money so you can spend it. You're going to the other side asking people to invest in your business, to take on that risk. So what do they get? How are you going to create value? What's your probability of success? Is it high or low? How do you measure success? Do you measure success by being a unicorn or just creating a profitable business? Your ambition should be aligned with theirs. Otherwise, they may not be a good investor for you. And pardon me, I'm just admitting a few people to the meeting here, which isn't working very well for the moment. Pardon me, one moment. Some technical difficulties here, admitting someone to the meeting. And is the risk consistent with the reward? Is your aspiration of being a huge company, is that risk consistent with the actual risk appetite of the investor? Again, if there's a misalignment there, you might be letting yourself in for a big problem, especially if you're raising money from friends or family. Do you know what investors want and need? Can you align with their vision? Do they view success in the same way? Again, each investor is different, but you should have a vision on this and what this actually looks like before going to each negotiation, each discussion. Do you know how investors work? Will they be quiet? Will they be very active? Will they help you? Will they ignore you? Will they invest more in the future? Will they be nice shareholders? This depends. It depends on the context. It depends on the business is going. But each investor might have a different style. So it's good to have a knowledge of this before you even enter into this process. Do you know how they process deals and how they prioritize in their portfolio? By processing deals, I mean that professional investors will look at hundreds of deals per year. They will say nice things to all those people because this is a people business, and they don't know who's going to succeed. So they probably won't say no. They might say not yet, we'll keep you in the loop. That basically means a no. Unless they're putting money or they're really engaging, it basically means a no for the time being, not a no forever, but that's how the business works. How they prioritize within their portfolio. Once they have invested in a portfolio, they may not reinvest in all those companies. We've all heard the stories of the entrepreneur who raised capital and then blames the investor who didn't give him more money just at the time he needed it, and therefore the company didn't succeed. And it sounds in that telling of the story that the investor was a bad person because they didn't give that runway of capital to make the business successful, whereas other businesses managed to succeed. By understanding how venture capital works, it actually seems like a rational thing to happen. They will focus within their portfolio. If they invest in 30 companies and they have a limited amount of capital remaining, and there are 5 companies which are experiencing much higher growth, those 5 companies will suck in the remaining capital of the fund, and they won't support those other companies as much. So it's a part of the model that some of those companies will have a mortality rate. So it shouldn't be surprising when that happens. The key thing is to know this happens in advance and plan for it and make sure that you're flexible. Understanding how valuations work. Valuations at the beginning of businesses aren't really very useful things. They're not valuations that somebody would buy the company in cash for. It's a valuation based on a methodology of what is the acceptable level of dilution at the beginning to make somebody my slave, to make somebody work for me, to make me as an investor to put money and make that person, work a huge amount of hours per week. It's based on that. If you buy a majority of the company in day one, the entrepreneur will disappear. So you can't do that. So the early stage valuations you hear are typically numbers which are extrapolations of what is the acceptable level of dilution, which tends to be around 20 to 30% in a kind of Series A scenario. So if you put in 100 million or 1 million, that's going to dictate the value of the company, which is a kind of backwards way of looking at it. But that's where you hear all these high valuations in the future. The company is worth hundreds of millions because and it's only 1 year old. It may not be. It may just have got one investor who likes the idea, puts in 200 million, who takes 20% of the company, which implies the company is worth $1 billion. Would you buy it for $1 billion tomorrow? No, of course not. You might buy it for 150, and you kind of make an arbitrage on the cash because there's 200 million of cash. That's worth something. But it's certainly the idea is not worth 800 million. That's never worth it in that case. So those valuations will have a kind of day of reckoning, and we'll discuss that in a little bit. But understanding where those numbers come from. You also hear references to pre-money, post-money, enterprise value, which are all slightly different wordings around roughly similar concepts. And then you hear lots of things about preferences. Preferences are the rights associated to certain shares, which have an impact whereby they sometimes implicitly reset the price of the valuation. So you can have a valuation of X, let's say 100 million, but the preferences actually mean or imply that the real valuation was substantially lower. But it's an implicit valuation where you do the kind of mathematical understanding of how much cash you get in return based on your shares. So again, when you hear about valuations, understanding the key thing is they're very volatile. They're not based on financial acumen or business acumen. And also they are misleading in some ways, not intentionally, but that's how the preferences are essentially working. Other considerations, the acceptable level of dilution. Is it worth arguing or negotiating or discussing for a long time on how much dilution you're going to get over one round, over multiple rounds? But these things are worth considering. You may be in a position where you simply refuse to ever be in a minority status. If that's the case, you probably shouldn't raise money from professional investors. Because that will be incorporated into their model, whereby you're almost certainly going to lose that majority at a point, even if you don't see it yet. But you're on a pathway, you're on a slope, which is difficult to turn back from, because you're running the company at a loss. This is the reason you're raising money in the first place, to run at a loss, which means you must raise more, which means you're going to get more diluted. Do you have preferred type investors? If you can't describe what your preferred investors look like, how will you know when you find them? So you should have an idea of what your expectation is from those investors. When I say the train might only stop once, if you get a firm offer, should you reject it? Should you keep negotiating? You can always optimize everything. Everything can be optimized. But once you reject firm offers, it's very likely that that offer will not come around again. I've seen many, many cases where companies have had good term sheets, reasonable term sheets, turn them down, and 2 years later, they're still a company of 6 or 7 people because they weren't ever able to regain that momentum on fundraising, and they simply couldn't grow. So they negotiated on some hypothetical number in the future, and then they lost the business today, which seems, certainly suboptimal, even though in their efforts to optimize the return. So again, be careful. If you have a good offer, it mightn't be what you envisioned, but that's what the market decided, and the market typically will decide that. Will decide that way, and it's up to you to accept it or not. Unless it's up to you to understand the process to make sure you don't only have one offer. The strength of scale, playing chess with probability.
Sorry to interrupt. We're having an issue with seeing the slides moving. Are you sifting through the slides?
I'm not at the moment. The slides are currently static. Which slide do you see?
Fundraising readiness financing strategy, the very first slide.
Ah, okay. That is not how it should be working. Let me unshare and reshare.
Thank you.
Okay, is that working now? You can see a slide that says the basics, some introspection.
Yes, we see that.
Okay, very good. Okay, these were the topics that I was going through. I apologize that I did not see those. I'm just reading some of the notes here. I think there may have been 1 or 2 questions as well. Okay, yes, pardon me. I was slow to see that, but they are all related to the slides. Okay, some quite specific questions. I'll have to come back to those later on. Okay, moving on. Some quick slides here, just on. I think one of you is still on. If you can mute, there's quite a lot of background noise. Okay, so in terms of models, mental models, how to conceptualize where the company is today, many of you will be familiar with these types of things, the adoption curve. It's not very useful, in fact, for investors, because you can never use it. You never know where you are on the curve. You never know how high the curve is going to be. But having some working knowledge of these types of curves, it can be useful at least to, on your side, to build a strategy and understand some of the mechanics and dynamics in the market. Now, I'm a technology investor, so I look at this through the sense of technology companies and their growth. But moving forward from this, we can look at technology curves, technology hype curves. This is also known as the Gartner curve, where the expectation rises pretty quickly. It also drops pretty substantially after a period of time and then tends to grow. But this is expectation. This is not about technology. So you think of areas like Bitcoin, for example. There was huge hype and then there was a trough and now it's kind of building again. We don't know if it's going to be any more drops. This is not a perfect model, but it's a conceptual model. But people tend to initially have huge expectations and then those ideas are whittled down and then reality kind of comes into play. These areas have known, so that the technology trigger, there's a peak, then there's a trough, and then there's a slope, and then eventually kind of rationality comes in, and there is genuine utilization of that technology. In between, there's a big drop. The question is, most technologies go through that. If you're a company on that path, how would you mitigate that? What would you do faced with that? Well, what this means is, if you can raise money at the beginning, when the expectation is very high, you might raise a lot of money at a high valuation. But knowing that if you don't progress quite quickly, there might be a huge down round in the future. You might have problems raising any money or money at a valuation that is remotely appropriate to you or based on your expectation. So how do you alleviate that? What would you do? How do you build a bridge to make sure you get across that trough? Again, these are things which most companies will actually face at a point in time. It's worth considering when the tide is turning against you. What do you do to keep building forward momentum? Technology itself will advance in any case. Expectation and technology are not the same thing, of course, but technology will just advance on its own. You typically can't make a huge impact on that. You're trying to time the market with the technology that you're using to differentiate. Now, the difference between that peak, of course, there's relative opportunity there. Technology itself is not a straight line, of course. It grows with a kind of S curve, where there's slow growth, then there's an acceleration, and then it plateaus itself again. For companies, they typically have to jump from one technology curve to the next. You think of automotive, from combustion engines moving to electric vehicles. The companies who are great in combustion engines, they have to make a leap. They have to jump onto a new technology curve, a new platform, and leverage that and build up. And the growth prospects in that market are much higher, of course. But these are issues that many companies face. For your company, it's worth knowing, where is your differentiation? Are you at the end of a cycle of a technology? Or are you at the beginning? How do you leverage it, and how do you mitigate that risk at the end of the cycle? Where is competition fiercest? Where is the competition least? This kind of helps you to understand, what's your strategic positioning? Does it make sense? Can you conceptualize it? Can you articulate it to potential investors and persuade them where your positioning, your timing, and everything is optimal for them to put money in the first place? Now, if you put all these things together, you might get something which looks a little bit like this. You have your basic marketing curve, where you have the innovations, your early adopters. You have the financing rounds, of course, which go roughly in that area. Again, this is not an easy thing to do. There's a huge element of difficulty actually creating this. You'll never know how do you get the market to adopt. And this is what's known as the chasm. It's very difficult to actually go from early. There's lots of early innovators, but that doesn't mean the mass market will ever arrive. This is equitable to the trough we saw earlier. And then your technology curves and technology will advance at different stages. This is not to complexify things, but for you, it's worth introspecting. Where is your company in that cycle, and how do you use that? I'm pivoting something now to dilution we mentioned earlier. Dilution is not so much of an issue for investors. They see how the game's going to play out. This is a quick graph here talking about the average. In fact, sorry, this is the median. This is the median based on a data set of around 9,000 companies of the level of dilution that a founding team will experience throughout the various rounds. So it's not precise. It will change depending on industry. It'll change depending on geography. But what it means is typically somewhere at Series A or Series B, the founding team are losing their majority. It can be later. It can be never. It can depend. It can depend on the types of shares. But these things typically will happen. So it's worth noting again, if you're fighting against losing control, once you start taking professional investors' money, you're on a pathway which makes that pretty difficult to turn back from. It's nearly worth accepting in front and then playing that game, understanding if you're not a majority, that's not a problem. It often brings about a company which is better governed, where there's no simple majority, and you have a kind of a diversified shareholding. So working with that, how do you use that going forward? You may consider acquiring other companies earlier than you had planned. To acquire the companies, you don't have the cash, but you may do it in equity and dilute yourself even earlier, knowing that you're going to be diluted anyway. But the key question is, when the company sells in the future, how much do you get? How much is your equity worth? At that point in time, you're not so much focused on the percent you have, you're more worried about how much money you get. And the point is, 5% of a huge company can be worth a lot more than 50%, of course, of a small company. So building something large, building a large enterprise doesn't really fall into the same discussion as dilution, as control. These are different things. From an investor's point of view, we don't look at dilution in the same way, of course. We don't have the attachment to it that a founding team would, but typically that's an inhibitor. It's an inhibitor to good decision making, and it's an inhibitor to building the enterprise as quickly and as readily as it probably can be done. Where is all the money going? You all hear about huge financing rounds in different geographies and different industries. This is just a quick analysis that we did at Jolt, looking at different geographies, looking at Europe, US, and Asia, and looking at the probability of going from a seed range round and then going to a Series A round. What you see across the board is that Europe in blue tends to be lower than Asia and US in almost every scenario, which means is you simply have a lower probability of getting financing at the same stage as you would do in other geographies. What it also says is that technology companies in those respective geographies tend to have a higher chance than non-technology companies also. So no matter where you are, if you have a technology company, so something slightly more defensible, something your assets are probably worth slightly more over a longer period, you probably have a better chance of getting financing as well. So depending on where you are today, what type of company you envisage building, again, worth considering. What are the chances of getting to the next stage of financing? If you don't, it doesn't mean you failed, but it has a high probability of meaning that, unfortunately. So if you reject money at Series A because the valuation is not right, you might spend another year or two trying to chase that money and never get there. What this says is you should factor in that the difficulty is actually getting harder each time to climb that ladder, to climb that financing ladder. So going fast is probably going to give you the best runway and actually to get there. But it is difficult, but these are kind of market statistics. For companies, it's challenging, but you have to be attractive. You have to stand out from the rest in order to warrant investors actually putting money in your company. Looking at it in a slightly different way, and this webinar will be shared again, so some of these slides you might want to go through again in slightly more detail. The graph on the right, it's just talking about the relative split of late stage financing and early stage financing across different industries, but I won't go into it too much here because I think we've a lot to discuss. Some key trends and things to consider. This is a graph here which illustrates a few different things. It's quite a complex graph, so let me just spend a minute or two on it. On the bottom axis, we have buckets of revenue range from 0 to 50 million, 50 to 100, 100 to 150, and so on. And on the vertical axis, we have the revenue multiples of those companies. And this is relative to companies in Europe, which are publicly listed companies. Now, this is based on technology companies. We did a scan of the market and we looked at technology companies in Europe in all these different ranges. We then looked at the growth rates of those companies. And what you see is something not very surprising. Perhaps the magnitude might be surprising nonetheless. Looking at the straight lines, the non-dotted lines. So the yellow line, this means a company which grew for the last 12 months at more than 15%. You see that if it's in the range of 0 to 50 million, it's worth approximately 2 times the revenue at an enterprise value. If it's much larger, it tends to be worth 3x. the revenue range. And this is the same phenomenon you see for companies which grew from 0 to 15%. This is the dark gray line. You go from 1.3x all the way up to around 1.8x or 2x. It's the same for the blue line. These are companies which grew less than 0%. So they actually declined in scale and size. And they go from 1x to about 1.5x. So again, the key message is the larger you are, the more valuable you are with respect to the revenues you have. Again, scale is important, really, really important. Big is beautiful in business. It's one of the best defenses you have. You all know the saying of the banks that were too big to fail. It's the same in business. Big is really supporting you. It's giving you a chance. First, you have to survive, then you have a chance to thrive. The dotted lines are just that same growth rate repeated over 2 years. So the dotted yellow line, these are companies which grew 15% for 2 years on the trot. And you see those companies are much more valuable than companies which did it for 1 year only. So these are repeat winner companies which repeatedly grow at a high rate. And surprisingly, you see the companies in the gray range which grow reasonably well for 2 years, they're worth more again. And companies in the blue which decline for 2 years typically are worth less, although there is some anomaly at the higher range. The key points are big is beautiful, growing fast repeatedly has a huge impact on your company. If you're not growing, you're stalling. You have to run fast to grow to create that perception of value. So this is more of the law of the jungle. You don't prize flexibility like Darwin says, you prize scale. You'd rather be an elephant than an ant, certainly in this situation. Deal making, what this looks like. This is all quite basic, but there might be a few things here which look a bit different. So the deal starts with an offer. The offer is accepted, the contracts are signed, it's closed, and you have a deal. But there's a few other things going on in the background which mightn't always be visible to the company. There's due diligence taking place between the acceptance and the signing. Due diligence will incorporate financial, HR, legal, operations, IP, intellectual property, the market, technology, ESG, and other issues. This is a lot of things to go on as well. This is run by the investor, by the professional investor. It can be longer or shorter depending on the investor, but these things are happening. For a company who's raising money, these all represent risk. These represent risk to you actually completing your financing round. So this must be dealt with utter care. You do not let the investor just have free reign over all these aspects. You manage it, you control it. Of course, you're fully truthful in it. You have the requisite disclosure. You're not asked to disclose things that you're not asked to disclose, but you must present an awful lot of that material to corroborate these points, so everyone feels comfortable. And there will be legal issues which account for things which perhaps were not shared. But this will be a relatively in-depth process, which will be very time-consuming for management of the companies. So it shouldn't be taken lightly. Depending on the law of where you are, of course, this can be done in different ways. Before the offer, the investor, they're going to negotiate, they're going to value the company, of course, but they're going to have their own approvals. It's not going to be one person who decides yes or no. This is not a kind of Caesar issue of saying good company, bad company. There's approval processes behind. And when the investor makes the offer, makes the investment, their reputation is now on the line. It's not something to take lightly. You're not getting offers from professional investors very easily. So when you do, it should be treated with the respect. It doesn't mean you should accept it, of course, but there's a working machine behind that where they have to prioritize, optimize it, and they're of course sourcing lots of deals. So you might have their attention for a specific period of time. It's worth using it well to accept or reject, but at least dealing with it in the correct way. When it comes to fundraising, the process itself, you're going to have things like NDAs in place. NDAs are useful, of course. They're confidentiality agreements. They are not always very useful at the beginning of a process. For example, if a company wants to raise money and shows me an NDA before telling me anything, I will never sign it. There is no reason for me to sign it. They're asking for millions of euros and they want you to sign something you know nothing about. This is ridiculous in many ways. So typically professional investors will never sign those. The reality is at that stage, the company is protecting almost nothing in any case. An NDA is to protect the company from leaking some critical information, some information that the people outside do not otherwise know or shouldn't know. If you're only protecting the fact you're fundraising, this is not really protecting anything. So again, ask yourself, When do you need an NDA? Why do you do it? We've closed investments at Jolt in relatively large companies without ever having an NDA, in fact. Sometimes we sign them much earlier. Again, it depends on the transaction, it depends on the technology, it depends on things. But if you're trying to raise money, you want to maximize the number of investors you're speaking to. Putting a barrier at the very beginning isn't always very helpful to achieving that. At a point, typically on Jolt's side, we will sign an NDA when we've talked to management once or twice and we're heavily engaged and we want to go very deep on the analysis at that point in time and really look under the covers. Yes, we'll sign an NDA then, but not prior. Advisors, bankers, do you need them? Again, it depends. It depends on your support. It depends on your management. It depends on your proficiency across things relating to corporate finance. It depends on your creativity of building stories, building PowerPoint slides. They are sometimes useful. They are sometimes a barrier. Again, it's very case specific. They can be expensive, of course, as well. If you're raising a modest amount of money, if you're raising 1 million and an advisor is getting paid 200K, it mightn't feel like a great expenditure if they help you to raise 100 million and they get paid 1 million. It feels a bit easier to accept. But again, you should be quite diligent on what you actually need them for. What are they going to do? Are they just going to be an agent between you and someone else and the counterparty? Or are they going to help you in terms of process, professionalization, in material, in de-risking the actual fundraising process? In that scenario, perhaps they're useful. Data rooms, it's just a small point there, but you will at a point, of course, have to give a lot of documents to the counterparty, to the investor, for them to actually analyze the company at a fairly deep level. You do not raise finance on one pitch deck. It might look like that when you Google sometimes and you find a pitch deck and a company raised lots of money. That's not why they raised the money. That was the first part of the process of raising money, and there were probably several hundred documents supporting that. As well. So don't get caught up only in having the perfect pitch deck and nothing behind it. You know the story about the emperor's not wearing any clothes. You must have something supporting that material, that depth of material to corroborate what you're presenting. That can be things like insurance contracts, rental agreements on the premises, employment contracts, the type of employment contracts, the IP licensing. All these things need to be qualified and checked, as well as lots more material and detail on your financial planning and your financial past. The due diligence process as well, we discussed earlier. The term sheet negotiations, these are absolutely negotiations. It's not something which is received by a company and they accept it or reject it. There typically is lots of back and forth when an investor presents a term sheet on very small information and very large things like valuation, the types of shares. It's worth a negotiation. Almost everything in life is negotiable. So don't be afraid to actually negotiate. Of course, know how to prioritize and know how to trade off. The rest of the words there are just some of the key documents which will be perhaps built depending on where you are, depending on the investor. But it is possible that a new investor, professional investor, will come in and they will bring a new shareholders agreement which the company, all shareholders will have to sign. If they buy out some shareholders, they might use a share purchase agreement. They will perhaps build new articles of the company, a new company constitution, and there'll be some representations and warranties and perhaps indemnities attached to it based on that the company will give to them or other shareholders who are exiting. These documents, all told, can represent 200 or 300 pages of legal work, which the investors will pore over in every detail, negotiating commas, rewriting clauses. On your side, you need to have good legal counsel who are commercially driven to help interpret some of those parameters that have been negotiated so that you can actually get into the material. You should know all these things which are going on. Some of these things might feel moot points. They might feel relatively small, but it's worth being in the detail because some of those things can come back to bite you at a point in time in the future. In terms of actually fundraising, it really is a process of evolving, listening and learning. You're going to make 20 pitches, 30 pitches, 40 pitches. You're going to get better as you go. So don't lose heart if it doesn't work in the beginning, of course. You may have to do an awful lot. One of the key things is to actually research your investors beforehand, understand a little bit about them and try and customize your pitch to them. We know this. As investors, we raise from large institutions. We raised a fund recently that's nearly 300 million. We have to do the same thing that you will do as companies, even if our investors are slightly larger. We have to go through the process. We have to refine. We have to be more precise in many aspects. When it comes to your business plan, this is your financial plan. This is going to be the big Excel spreadsheet that you're holding up and you're using to justify the financing claim. Again, as investors, we will go through that and we will pick it apart very quickly in quite a lot of detail. But on your side, it's worth asking some various questions. Is the revenue plausible? If you're projecting revenue growth in the future, what makes that even reasonable? Is it based on what? Is it based on the growth rate of the market? But does that incorporate how you sell? Do you have a sales team? Do you sell direct? Do you go through partners? If it's not reasonable, it looks risky. When it comes to the expenditure, the OPEX, the operational expenditure of the company, that's typically easier to achieve than revenue. If your business plan is based on having very large growth in revenue and very large growth in operational expenditure, one of those has a higher probability of succeeding, the spending side. So you may spend a lot of money and not bring in all the money on the revenue side, on the top line, which means you're going to be hugely negative. You're going to lose way more money than you planned, which means you're going to raise money much sooner than you planned. And that valuation might be much lower than you would hope for as well. So these things must be consistent. When you start getting into the actual deep into the model, you're going to look at, are the lag times reasonable? If you make a choice to hire someone, how soon can you hire people? If we give you money today as investors and you want to hire a team of 10 people, do you do it in 1 week or do you do it in 6 months? It depends on the person and the profile you're going after. But your model shouldn't assume you'll hire everyone in 1 day. It shouldn't assume you train them in 1 month either. That's also not realistic. If you're selling complex software, if you're selling machinery which requires lots of training on it, you can't assume in your financial model you hire them in 1 day and you train them in 1 week. These things take much longer. Equally, the sales process might be much longer. The sales cycle might be 6 months to 12 months for certain complex software or for hardware companies. If it's 6 to 12 months and the training time is 6 months and the hiring time is 6 months, it means when you hire someone, it can be 1.5 years to 2 years before they make an impact on the revenue. So your model shouldn't say you hire someone today and they generate revenue tomorrow. That is inconsistent with actually how the market works and how it functions. Equally, you may have a lead time in manufacturing. If you order something from your manufacturer and it takes 6 months to be delivered, you can't assume you're generating revenue today. So these things must be all consistent. Is your working capital optimal? Are you running this in a relatively optimal way? Not perfectly optimized, you're still going to be a small company, but is it crazy? For example, are you paying bonuses to salespeople before the cash comes into the company? If so, that looks a little bit crazy because you may not have got the cash from your sales. The sales may not have been made. You may only be booking. The sale is not completed. The revenue has not arrived yet. The cash might not arrive for 6 months, but you're paying a bonus to the sales guy to keep them happy. That is crazy for sure. And that's difficult on the working capital side as well. And that's going to have lots of other issues in the company. Is your liquidity sufficient to actually grow how fast you want to? And then at a higher level, what's the runway you have? If you raise X amount of money, it enables you to survive for how long? 6 months, 16 months? It depends. But what are you going to do along the way which looks like you've generated value? What line in the sand, what milestone says that is going to convince an investor, my 5 million I put in the company over the last 12 months, they have achieved certain things which makes me feel they've created more value. If you don't have those lines in the sand, those stakes to plant and say we've done something, if you just say we've spent a lot on sales and the market's going to arrive eventually, it feels weak. If you say you have built out huge pipelines, the data generation of your users has increased 1,000 times, yes, you may not be monetizing it yet, but it feels like you've made a lot of progress. Again, you need to find a way to have the right KPIs, the right milestones, which talk to your investors, which they understand, because you will use them on your next fundraising round where you want those investors to put more money. Do you have non-dilutive financing available? Again, are there subsidies? Are there grants? Are there other cheap debts? With COVID, there's been lots of access to kind of funny financing available for companies. Do you avail of it? If you do This is good for your equity holders, especially grants and subsidies, if they're not distracting you working on projects which are very tangential. It's not free money, but it's close to free money to develop your company. If you're not taking those grants, that's fine. But if you do you have a higher probability of getting equity investment? Probably, because you're de-risking that equity. So if you can find a way to parallel process and leverage these different financings, that's going to help. What assumptions underpin your business plan? Again, the business plan should be relatively dynamic. If, for example, something macroeconomic changes, COVID, for example, you should be able to toggle with your business plan on the growth rate of a market, for example, the size of a market, the size of the sales cycle, how long it is, and you would see this naturally adjust in your Excel model. If you don't, it looks weak. So there should be underpinning assumptions which are logical, which are reasonable, which are supporting this. Again, this touches on logistics, sales, client churn, upsell, employee churn, acquisition costs, lifetime value, the concentrations of customers which impact your ability to work on other sales. All these things, you're going to make assumptions projecting the next 3 to 5 years of your business plan. All these assumptions will be implicit in your head, but they should be explicit to an investor reading it so that we can toggle with those and assess the sensitivity. If you don't do it, we will anyway. And we're going to have different assumptions to you, and they mightn't be as generous to your company as you would otherwise want them to be. If you front load it and do the work, you can control the context, you can control the narrative. It's more work, it's more playing with Excel, but it's definitely in your advantage. Whoever controls the numbers tends to be having at an advantage. If an investor asks you, is acceleration possible in your business plan? We're not trying to erode the business plan or say it's illogical. We're just trying to diligence it and check the integrity of it. If we ask, can you go faster? What if you're raising 5 million, but we say, do you want 10? What would you do? If you don't have a plan for that, or you don't know what you would do, it looks like you're at the edge of your comfort zone. It looks like you haven't fully thought through how to scale the company. You should know the answer to that. You should know what you would do with the extra money involved. It's slightly hypothetical. We're not saying you should have that in your pitch deck, but that's a question you should know the answer to. Again, acquisitions. If an investor says, would you buy a competitor or someone downstream or upstream, if the price was reasonable and they were going to bring you a loyal team with some assets, with some revenues, what would your answer be? Yes, no, you like the idea or not? You should have an answer to that idea. It might give you a second life as the CEO, as a founder. As we saw earlier, you're going to be diluted at a point, probably below majority. So you won't be able to stay as CEO forever. You can be outvoted. If you have a parallel growth plan, which is leveraging inorganic growth, you might get a second chance to go. If the company is stalling, you might be able to convince your investors to actually put in more money to make an acquisition of a competitor or some other supplier or some other kind of tangential company, which brings about an economy of scope and an economy of scale. This can make a lot of sense. So don't be afraid to think inorganically. Even if those investors are not advocating that initially, you should start looking at that. It's only going to help you understand your ecosystem more clearly as well and understand where the real value is. As investors, we try to be surgical. Where in a value chain we invest. We try to be precise. As companies, you should be too. Where is the best bargaining power in the value chain? How do I get there? How do I increase my value? Again, how dynamic or how buoyant is your business plan? That was in relation to the assumptions. If I toggle with those assumptions, what's going to change? If I reduce my revenue, how does that reduce the ramp up in my OPEX? If the OPEX stays the same, but the revenue drops, we know that the company loses lots of money. So there should be some natural adjustment, natural buoyancy on the cost side if you don't have the same level of financing. Now, all that, and that's quite a lot, but is that consistent with what you did in the past? If it's not, you should be able to tell me why. If it's going to be changing, that's fine. We all have probably a rosier opinion of the future than the past, at least in terms of our hopes, our aspirations, our expectations, but you should be able to tell us why. You cannot say we did in the past, we'll do in the future, but when I check your model, I see something which looks very different. So again, you should be pretty clear on these processes. That's quite a bit of work, I must say, but again, people who do it control it much more clearly. On the pitch deck, the pitch deck is probably much easier to go through. Maybe I will stop there and invite any questions. The pitch deck, of course, we know the various components. a pitch deck is going to have. Any questions at that point? There was quite a lot of information on the previous slide about building a business plan to be coherent with a fundraising. Okay, if no questions at that point, I will just continue on here with the slide on the pitch decks. This will be quite simple to many of you. You'll have seen this in many different ways. A pitch deck, this is not an exhaustive analysis of the perfect pitch deck. There is no perfect pitch deck. It's always going to change and it's going to evolve. But always you must have something with the market, of course. It should be top down and bottom up. You should look at it at the macro, but you should look at it at the micro. Is there data you can get your hands on which corroborates, justifies the assertions or the assumptions you're making from a top-down analysis? If it's very, very high level, it's not useful. If you tell me the automotive market is worth 60 billion, but you're only selling one tiny component, which goes into each wheel, I can't really use the market of automotive to understand the market of someone selling small bearings that go into a wheel. That's not very useful as a proxy. So you must kind of find your segment of the market and find a real market, actually a number that we can use attached to. Again, this will be used in your business plan as well. When it comes to your solution, of course, your USP, your IP. Do you license IP elsewhere? Do you license it under what provisions, what circumstances, what costs? But what's virtuous about your business? Does your business get stronger for each time someone uses the product, uses the software? If not, why not? You must find a way to show something is increasing with scale. The momentum is building. As we saw earlier, the momentum is magnetic in terms of attaining capital. It should be the same way in your business model. In terms of traction, milestones, and roadmap, we should know something about where you're going. You are somewhere today. You did something in the past, and you created lots of milestones, and you're going somewhere in the future. We should see that clearly. We should know the milestones you're going to meet in the next 6 months, in the next 18 months, and we should be able to understand what we as investors are going to invest into to enable you to achieve those. We might ask that question on acceleration, of course, as well, but we must understand that vision pretty clearly about where you're going. If you don't understand that's a big problem. When it comes to sales go-to-market, I think that's going to be pretty clear. There's various different ways to do that, but that's quite a deep topic on its own. When it comes to competition, you should have a real competitive analysis. You can have done that by self-generate. That can be more than an XY axis where you're at the top right on something which is sometimes nonsensical. You should have done a real analysis. That can be your own matrix, based on 10 or 12 different axes of comparison, where you have done it manually by looking at your competitors based on the input, the market knowledge you have, the inputs you have from your team, and also refer to other studies. Do this, but it should be coherent. If it's weak and your competitor analysis looks weak, it looks like you don't know your own market, which means you're lacking in credibility. You don't look like a good CEO. You don't look like someone who is in the detail at the point in time, which again, do those people look like good custodians of your millions of euro? Probably not. You must demonstrate that you, again, you're in all the detail here. Your team, of course, you present that with your advisors. That's good to be kind of more legitimate. Companies with 2 people don't raise money easily, because if an accident happens, of course, there's only one person left. So you need to look like a team. You need to look like you're building an organization, of course. You need to present a strength of size, of scale, of course. When it comes to the amount, why that amount? And again, what if more is available? But you must justify that, and you must tell the investors where that money is going. How will that money be invested? What percent in R&D? What percent in sales? What percent in acquisition? What percentage in working capital? It should be, in the pitch deck, it doesn't have to be so granular, but it should be pretty granular, of course, in the business plan. But you should articulate it pretty clearly. The more precision you have, the more understanding of why you're allocating that money. Again, that looks great. All that looks like is that's a very professional CEO. On the deployment of funds, again, keeping it up to date. Your slide deck will change every 2 weeks, perhaps even more. Your business plan might be changing even more frequently at times. Keep it up to date. Nothing worse than presenting something that you presented 6 months ago. It's out of date, vastly out of date. Many things have happened. You may have achieved 2 large milestones in that time. So again, keep it up to date, because you don't know when you're going to meet the perfect investor. Again, there are various additions that some investors will bring to the company beyond capital. I won't go through those here, but again, we can share those at a different point in time. I also have some material on what separates venture capital from private equity, but that is probably a little bit too detailed for now. I'm going to skip to one slide on messaging. When presenting some of the things, and this is referenced, I took this from a Medium post, because it neatly summed up many of the things and many of the communication issues you see when companies are presenting, which feels like something good on their side, but investors hear something else. So we call this your messaging risk. What is said is not always what is heard. So when someone is stating that they think their business plan is conservative, that might sound like something good, because it sounds like the upside is huge. To an investor, that might sound like the entrepreneur doesn't really know what he's doing, that they think they build a company and people will just magically show up to buy it, that they don't understand the complexity of acquisition, which is in fact the most important job. So be careful. Communication is something. Fundraising is corporate communication. It's not personal communication, telling personal stories. It must be kind of precise. It must be de-risked. It must be thought through. And I should be careful to understand the considerations and the knowledge base the other side has. Other entrepreneurs would say they've got most of their round committed. They're only looking for a lead investor. For an investor, they know that means basically nothing. It means that they've spoken to lots of investors and none of them want to invest. And they don't realize that most of those investors, instead of saying no, they're just saying something polite like, keep us up to date, or not yet, or we might come in the future, or if you meet milestone X, we might come. It sounds like a soft commitment. The reality is there is no soft commitment. Someone invests or they don't. It's basically binary. So by having that statement, it sounds like good. It sounds like you're looking for the last linchpin, the last kind of capstone. In fact, the investors will see it the exact inverse way. They see it as a sign of weakness. Will be cash flow positive in 18 months. That doesn't mean very much. That again sounds like a lifestyle business. Investors want a large upside. The chances of early stage companies succeeding is very, very low, which means the risk is huge. To tolerate that level of risk, the upside must be huge. If you're building a business which is going to be modest in size, the risk and reward don't make sense. So you're saying you're probably going to fail, but if I succeed, you'll make little money anyway. It doesn't make sense. So, and those businesses tend to be too conservative, taking profits too early and not building real differentiation, which prevent them actually yielding real capital returns in the future in any case. So a big issue. Saying we don't have any competitors. Again, we hear this quite a lot. People who believe their idea is what separates the company and focus only on the idea, not on sales. The reality is, if there's no competitors, there might be no market, and there might be no market for a very good reason, because nobody wants that market. Nobody wants that part of the value chain, and they've all stayed away from it. So, what you're saying and what I've heard aren't the same thing. Again, the people think they're going to win because they're a superior product. They don't really understand why people are using products. That's not why people are generating affinity to a brand, or why they're recurring customers, not just because of the product. There's some other level of buy-in, reputational, or much more than that, even emotional, which is much more than just a product basis. There becomes a greater affinity. So again, the key message is communication is really, really important. So it's not to remove all personality from pitching, from communication, but these types of statements here don't add much value. They act like they come across like feigned confidence, which in fact is not really benefiting the company or the fundraising process. In fact, it's kind of signifying weakness to an investor. So again, being relatively careful, I think, on the communication is pretty important. We are now 1 minute over time, so I will stop there. As you now know, I could probably talk for much longer on these topics. Any questions that I can give an opinion on to any of you?